Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
It is good to be back. And, looking at the screens this morning, we have quite the week ahead of us.
We really do. So it's Monday, February 16th, 2026. And if I had to describe the mood out there, I'd say it's a bit of a tug of war. We're seeing this really distinct split between, well, comfort and fear. And they're pulling the markets in two completely different directions. It's like the market can't decide if it wants to panic or throw a party.
That's the perfect way to frame it. I mean, on the one hand, you have the comfort side of the equation. We just got U.S. CPI data, the inflation numbers, and they were muted.
Right, which is exactly what investors wanted.
Exactly. And plus, and this is a bit of a curveball, we're seeing geopolitical tensions with Iran actually cooling down, which we'll definitely need to unpack that in a bit. The details are fascinating.
Okay, so that's the party side. But then you look at the other side of the rope, and there's this creeping, I guess, AI fear. It feels like the narrative is shifting from AI is going to save the world to, wait a minute, how on earth are we going to pay for all this?
That is the pivot point. We're moving from the dream phase of AI to, let's call it the construction phase. And let me tell you, the construction phase is expensive. And that fear is causing some serious rotation in the stock market. You saw it in the close on Friday, right? It was mixed. The NASDAQ, which is so tech-heavy, was down 0.22%.
But the Dow is up.
But the Dow, with all those, boring and industrial and legacy companies, it managed to squeak out a 0.10% gain.
So, okay, we've got a roadmap to get through today. We are going to dive into that dark side of AI and this staggering $3 trillion bill that's coming due for data centers.
And we're also going to look at a very surprising diplomatic turn with Iran involving Marco Rubio, of all people, and what that means.
Plus, we have to talk about TikTok. I mean, everyone thought the user base would just vanish after the joint venture was announced, but spoiler alert.
They didn't. Not at all.
And we'll touch on the media wars, Warner Bros. Discovery, potentially back at the table with Paramount, and some really serious findings on crypto and human trafficking.
Right.
And just to keep us from spiraling, we'll check in on Japan's non-recession and find out which country is paying nearly $800,000 for an Olympic gold medal.
And it's not the U.S.
Okay, so let's unpack this AI situation first. We're looking at a report from Yahoo Finance. The title is The Dark Side of AI, and it feels like Wall Street is suddenly waking up with a hangover.
It really does. For so long, the narrative was just pure growth. But now, investors are weighing a stock sell-off that's driven by disruption fears. We are seeing a rotation out of the high-flying tech names.
And into what?
Into what we call safe zones.
The safe zones? That sounds like a bunker. Are we talking about toothpaste and bandages here?
Essentially, yes.
Yeah.
Consumer staples, financials, and healthcare. In fact, consumer staples are rallying in 2026. I was reading a note from Elrak Hoffman-Burchardi. She's at UBS Global Wealth Management. And she made this really interesting point. She believes that business models in financials and healthcare are actually poised to benefit the most right now, while all the tech giants are facing scrutiny.
So let me see if I get this. The logic is, I don't know if this AI chatbot will make money in 5 years, but I know people will still need to brush their teeth.
That's the logic of the defensive investor, yeah. It's all about cash flow visibility. But there is a bigger, scarier number looming over this whole sector that explains why they're fleeing tech.
Okay.
Bloomberg put out a report on the AI data center boom, and the headline number is just jaw-dropping. We're looking at a bill to build out this infrastructure.
Give me the number.
$3 trillion.
$3 trillion. With a T. That's larger than the entire GDP of the United Kingdom.
It's massive.
Yeah.
And the immediate question Wall Street is asking is, who writes that check? Because right now, companies aren't just paying cash. They're going to the debt markets. Credit markets are quietly becoming the backbone of this entire AI build-out.
That sounds incredibly risky. I mean, if you're borrowing trillions to build data centers for AI models that are still arguably experimental when it comes to profitability, what happens if the revenue doesn't show up?
That is the risk premium. And we're seeing it in the derivatives market. Bloomberg cited Rory Sandilands over at Egon Ltd. He noted that he has more credit default swap trades, CDS trades on his book than a year ago.
Okay, hold on. Pause there. For anyone who doesn't trade bonds before breakfast, break down what a spike in credit default swaps really tells us about the market's psychology.
Think of a CDS as fire insurance. You buy a house, you buy insurance in case it burns down.
Sure.
If suddenly everyone on your block is buying fire insurance and the price of that insurance doubles.
It means everyone smells smoke.
Exactly. It signals that smart money is worried about a bust. They see that massive debt load and they get nervous about default. And to make it even more complicated, you have the political angle. CNBC had a fascinating report on Peter Navarro, who's advising the Trump administration on trade and manufacturing.
Yeah.
This is where it gets really interesting for corporate balance sheets. Navarro is suggesting that the White House plan might essentially force these data center builders to internalize the costs.
Internalize. That sounds like corporate speak for you're paying for it.
That is exactly what it means. I mean, usually with a massive infrastructure build-out like this, think highways or the early internet companies pass costs on to the consumer, right? Or they get subsidies.
Right.
Navarro is suggesting the administration wants the companies to just absorb these costs themselves.
So if I'm a shareholder in, say, big tech company X and they have to internalize a $3 trillion bill, that money just comes out of my dividend.
It comes out of margins.
Right.
Which hits earnings, which hits the stock price. It just changes the profitability equation significantly. So you have massive debt to build the things and political pressure to eat the costs of building them. No wonder investors are rotating into toothpaste and banks.
Yeah, that creates a lot of uncertainty. Oh, and just a quick personnel note. In the middle of all this AI chaos, CNBC confirmed that Peter Steinberger, the creator of OpenClaw, is joining OpenAI. Sam Altman confirmed that himself.
So the talent war is still raging, even while the financial war is heating up.
It's an arms race on every front. Okay, let's pivot. Let's go from digital wars to the actual geopolitical landscape. Because if the tech market is making people nervous, the geopolitical scene is surprisingly calming.
It's a strange dynamic, isn't it? We're looking at a report from the CNBC Daily Open about U.S. Secretary of State Marco Rubio. He was at the Munich Security Conference this weekend.
And usually those conferences are just full of dire warnings about the end of the world.
Usually.
Yeah.
But Rubio was there providing what the report called comforting words to Europe, just reassuring allies. But the real headline grabber, the thing that's really helping calm the markets, is coming out of Iran.
Yeah, I saw this headline and I had to do a double take. Iran is talking about deals with the U.S.
It appears so. The headline literally says that Iran says potential energy, mining, and aircraft deals are on the table in talks with the U.S.
That feels like a massive shift from the rhetoric we were hearing even just a few months ago. We went from maximum pressure to aircraft deals.
It's huge, and markets love stability. When you have cooling tensions in the Middle East, that removes a massive risk premium from the board.
Sure.
And you can see the ripple effect immediately in the oil markets.
Right. Bloomberg had that report. A huge bet on supertankers.
Right. Someone is placing a massive wager on logistics, and this bet is reverberating through the oil market. Basically, because that geopolitical risk is fading a little with these Iran talks, oil prices are steadying.
So the market isn't pricing in a war.
Not right now. It's pricing in commerce.
And that stability flows into currencies too, right? This is where I need you to explain something I saw in the Bloomberg notes. It mentioned the carry trade is making emerging market currencies more stable than G7 currencies.
Yes. It's a fascinating inversion. We're seeing emerging market currencies actually outperforming some G7 currencies in terms of stability.
That seems backward. Usually when the world gets scary, everyone runs to the US dollar or the Swiss franc. Why are developing nations holding up better?
It comes down to that mechanism you mentioned, the carry trade.
I hear that term thrown around constantly on financial TV. So break it down. How does the carry trade actually work here?
It's a strategy where investors borrow money in a country with low interest rates, like Japan, for instance, and then use it to buy assets in a country with high interest rates, say Brazil or Mexico. You pocket the difference.
Okay, so I borrow cheap and lend expensive. But isn't that really risky? If the Brazilian currency crashes, I lose my shirt.
Precisely. That's the risk. But right now, because commodities, oil, mining, metals are stabilizing because of these talks with Iran, the economies of those resource-rich countries are stabilizing too.
So let me trace the line here. Because Iran and the U.S. are talking, oil is steady. Because oil is steady, commodity countries are steady, so currency traders feel safe parking their money there.
You connected the dots perfectly. It's a chain reaction that starts with a handshake in Munich and ends with a stable currency in Brazil. Meanwhile, the G7 nations are dealing with that $3 trillion AI debt we just talked about.
It really is a topsy-turvy world. Now, speaking of things not going the way we expected, let's talk about TikTok.
Ah, yes. The mass exodus. That
Yeah.
wasn't
Right. I remember back in January when the joint venture was announced, everyone said, that's it, the kids are leaving, the app is over. But we have a CNBC report here asking much ado about nothing.
And the data says, yes, it was much ado about nothing. According to Sensor Tower, despite a brief spike in deletions right after that January 23rd announcement, usage has rebounded.
How much?
Daily active users are sitting at roughly 95% of previous levels.
So practically everyone stayed.
Essentially. The analyst view is pretty simple. For the average user, the experience is still strong. The product works. It's addictive. People don't leave a platform that entertains them just because the corporate structure chart changed.
But that structure chart did change significantly. Let's just remind people what the TikTok USDS joint venture actually looks like.
Right, so this was created to comply with President Trump's executive order. ByteDance, the Chinese parent, still has a 19.9% stake. But now you have Oracle, Silver Lake, and MGX, which is an investment firm from Abu Dhabi, each owning 15%.
And Oracle's Larry Ellison is the one under the microscope here.
He is. The report mentions that Ellison is involved in retraining the algorithm on U.S. data. And that is where all the controversy kicks in.
Yeah, this is the part that got people riled up. There was speculation that the new algorithm would, suppress content critical of ICE or maybe push pro-Trump content.
And there was that one specific incident that really fueled this. CNBC confirmed that for a period, if you messaged the word Epstein on TikTok, it triggered error messages.
That's oddly specific.
It is.
I mean, come on. A specific name triggers an error. That feels less like a glitch and more like a filter, doesn't it?
Well, to be fair, we have to report their defense. A TikTok spokesperson told CNBC they do not prohibit the name Epstein and were investigating glitches. They attributed some of the broader issues to power outages.
Power outages, that's a convenient culprit. Sorry I censored your political speech, the lights flickered.
It is a convenient explanation. But here's the takeaway. Whether it was a glitch or a feature, the data shows users didn't care enough to leave. The content flow is largely the same, and as long as the videos keep playing, the user base is stable.
It's a testament to how sticky that product is. If you provide enough dopamine, people will overlook a lot of structural changes. Okay, let's move from social media to legacy media. The media wars are back, and it sounds like Paramount is playing hardball.
Hardball puts it mildly. We're looking at a Bloomberg report, via CNBC, that Warner Bros. Discovery might be reopening sale talks with Paramount, but Paramount has added a poison pill to the deal, or maybe a ticking clock.
I saw this term in the notes, a ticking fee. It sounds like something a lawyer invented just to ruin someone's day.
It's a mechanism designed to punish delay. Paramount is trying to fend off a competing offer from Skydance. So they told Warner Bros., if you want to buy us, fine. But for every day, week, or month that regulatory approval gets delayed, the price goes up.
How much are we talking about?
They proposed adding 25 cents a share to the offer for every delay.
25 cents doesn't sound like a lot when you're buying a media empire.
It doesn't, until you do the math. There are hundreds of millions of shares. When you aggregate it, that 25-cent hike translates to roughly $650 million in cash per quarter.
Good Lord. So it's a $650 million quarterly fine just for bureaucratic slowness.
Essentially, it forces Warner Bros. To look at the deal and ask, can we actually close this fast? Because if the regulators drag their feet for a year, the price tag balloons by billions.
It's almost a reverse option. The longer you wait, the worse the deal gets. It puts massive pressure on Warner Bros. Discovery to decide if they can afford this poker game.
It does. And speaking of big deals, we should quickly mention Quaib Holdings.
Yes, looking outside the U.S. for a second.
A massive takeover deal down under. Macquarie Asset Management in Australia is involved in an $8.3 billion takeover of Quaib Holdings. It just shows that while the U.S. media giants are dancing around each other, big infrastructure deals are still getting done globally.
Absolutely. Now, I want to shift gears to something much more serious. We talk a lot about crypto prices and ETFs, but there's a report from CNBC covering a study by Chainalysis that reveals a really disturbing trend.
This is a heavy one, but it's important to understand. The report details how crypto is playing a growing role in human trafficking, and specifically in child sexual abuse material, or CSAM, networks.
And the mechanics of this are changing, right? I think a lot of people assume this is all happening with Bitcoin.
That's the old model. And that's the challenge for law enforcement. The traffickers are moving away from Bitcoin, which is actually relatively easy to trace. They are moving toward privacy-focused assets like Monero.
Monero! That's the one designed to be untraceable.
Correct. And they're using these instant exchange services that don't require an ID, so they're effectively washing the money in real time. But the Chainalysis report found something else that's just chilling. About half of the transactions they tracked were under $100.
That seems small. Why is that significant?
It seems small, but it indicates a subscription model. These aren't just one-off payments. People are paying monthly fees to access private chat groups. It's become a commercialized industry of abuse.
That is horrifying. It turns it into an actual business model.
It does. And the report also mentioned an overlap with other groups. They found overlaps between these CSAM merchants and what they called sadistic online extremism groups. It's a convergence of the worst kinds of bad actors.
It really highlights why regulators are coming down so hard on the crypto space. It's not just about protecting investors from losing money on a meme coin. It's about shining a light on this dark underbelly.
That's the reality. As the technology matures, the methods for exploiting it mature too. It's a major regulatory target for 2026.
Okay, that's heavy, but necessary to cover. Let's try to find some lighter ground to close out with our economic potpourri. First stop, Japan.
Japan, the land of the rising sun and the flatlining economy. CNBC reports that Japan avoided a technical recession, but just barely.
Barely is the key word there.
Very much so. The economy expanded by 0.1% in the fourth quarter of 2025.
0.1%, that's basically a rounding error.
It's better than zero, but it missed the 0.4% expectation.
Yeah.
So they aren't in a recession, but it's not exactly a boom time either.
Speaking of things that aren't booming, breakfast. I saw a headline about America's free hotel breakfast facing a K-shaped economic threat.
This is actually a fascinating microcosm of the economy. From Hyatt to Holiday Inn, hotels are rethinking that free buffet. The K-shaped threat refers to the split we see everywhere.
So the rich get richer and the poor get no waffles.
Pretty much. Luxury travelers are seeing better perks, while budget travelers are seeing amenities cut back to save costs. The days of the unlimited free waffle might be numbered for the economy traveler.
That is a tragedy. I love those waffle makers. It's the only time I cook.
It's the end of an era.
And finally, let's talk about the Winter Olympics. CNBC had a fun breakdown of medal bonuses. If you win a gold medal, your country usually gives you a cash bonus.
Right. And there is a massive disparity here.
Who is top of the leaderboard?
Singapore. If you win a gold medal for Singapore, they are offering a payout of $792,000.
Nearly 800 grand. That's life-changing money.
It is. Contrast that with other countries like the U.S. where the payout is significantly lower. We're talking tens of thousands, not hundreds.
Why is that? Is the U.S. just cheap?
It's about scarcity. The U.S. wins a lot of medals. If they paid $800,000 for every gold, it would bankrupt the committee. For a smaller nation like Singapore, a gold medal is a rare historic event, so they place a massive premium on that global prestige.
Time to start training for the curling team, I think.
You might need Singaporean citizenship first.
Details. So, looking at everything we've covered today, from $3 trillion AI bills to Iranian aircraft deals to TikTok algorithms, what does this all mean?
You know, if we synthesize all this, the market is currently pricing in massive structural changes. We're moving from a period of easy growth in tech to a period of hard costs. That's the $3 trillion infrastructure bill. At the same time, the geopolitical alliances that defined the last decade are shifting under our feet, with the U.S. and Iran talking deals. And in media, the old guard is desperately trying to consolidate before the tech giants swallow them whole. It's a restructuring of the global order, both financial and political.
It certainly feels that way. And here's a final provocative thought to leave you with. With AI disrupting industries and algorithms potentially being retrained by new owners, like we're seeing with Oracle and TikTok, are we moving into an era where truth is just another asset class to be managed by the highest bidder?
That is a question worth pondering.
We'll see you all tomorrow morning with new headlines from major financial magazines.